The Fed's been operating its monetary policy while looking in the rearview mirror because they keep creating inflation, right? Printing money, quantitative easing, whatever you want to call it. And they keep printing more and more money. And they look in the rearview mirror and they look at the CPI. And as long as it's below 2% or some version of it is below 2%, they think it's okay to keep printing money. Meanwhile, they're ignoring the road ahead. They keep looking in the rearview mirror at these CPI numbers. And they kept, printing money and inflating asset bubbles and distorting the economy and leading to these debt bubbles and letting the government get bigger and bigger and bigger, spending more and more borrowed money. And then all of a sudden they look in the windshield and they're staring at these big CPI increases. And their initial reaction is, oh, don't worry about it. It's nothing. And then after a few more months, it's transitory. It'll go away. And now they've got this huge problem, which has been inevitable for a decade. In fact, back in 2009, when the Fed first made the mistake of going down this road of quantitative easing and 0% interest rates, I predicted exactly the predicament that they're now going into because they have this massive inflation problem. They can't do anything about it. They're talking about tightening up on policy, but what they're talking about doing is going from very loose policy to slightly less loose policy. They're not talking about tight money, which is what they would actually need to put out this inflation fire. By tightening up a little bit, they're going to prick the bubbles, or they've already pricked the bubble, and you're seeing all these risk assets imploding right now in price. The economy is already rolling over into recession just because the Fed is supplying less monetary heroin than they were. But the fact that they're still supplying some means that the inflation problem is going to keep getting worse. So this is the Fed's worst nightmare. It's stagflation. And the question is, what are they going to do? Are they going to keep tightening up policy and push the economy into another financial crisis, not just a recession? Or are they going to reverse any rate hikes, expand quantitative easing, and just make the inflation problem much worse? 7% is the number that you get when you use their rigged methodology for calculating consumer prices. And they often compare the inflation today to the 1970s to try to make it appear like it's not that bad. Oh, yeah, it's 7%, but it's nothing like the 1970s. Well, it's actually worse than the 1970s. If you used the same CPI that was used to measure prices in the 1970s, and if you use that identical CPI today, last year was actually worse than any year during the decade of the 1970s. It was about 15%. And the bad news is a lot of companies held back on price increases because they thought it was all transitory. Well, now that they realize that's not the case, you have a lot of companies that are rushing to make up for lost ground, and they're announcing major price hikes here in January. They're probably going to do more later in the year. Look at the price of oil. It's already exploding. It's up about 20% in the last few weeks. We're at a new high for the year. We're at $85 a barrel. I think we're headed over 100 this year, maybe closer to 150. I think by next year we'll be above 150 in the price of oil. It's not just oil. It's all sorts of energy, but it's agriculture. It's industrial materials. The government is trying to blame it on a supply shortage. It's not a shortage of supply. It's a surplus of money. It's all the money printing that is creating the problem. Had the Fed done the right thing after COVID and contracted money supply, then we wouldn't see these big price increases. Maybe there would have been a reduction in supply, but there would have been an offsetting reduction in demand. Instead, we reduced supply because everybody was staying at home instead of working, but we increased demand because we gave all the people who were staying at home more money to spend than what they used to earn when they actually went to work. So it was the worst of all policy mistakes. We threw gasoline on the inflation fire, and now we're dealing with the consequences, and it's just getting started. The problem is they're going to raise rates enough to crush the economy, but not enough to slow inflation. And in fact, as inflation gets worse, that's going to be another drag on the economy. And so what you've got to do, what I'm trying to tell you, is you've got to get out of all of the bubble assets that were propped up by all the cheap money. Because even though money is cheap, it may be slightly less cheap for a while, and that's enough to collapse the bubble. But you can't just go to cash because inflation is very high and it's eroding away the value of your cash. There's no safety there. You can't buy bonds. Bonds are even worse than cash because it's cash in the future. But in the meanwhile, you're tying your cash up and inflation is eating it up. So people have to go out of these risky momentum stocks into value. And what we're seeing is a massive shift out of U.S. growth stocks to international value stocks, stocks in Europe, stocks in Asia, basic businesses that have real earnings right now, that pay good dividends right now. That's where investors are hiding out. That's why you're seeing some of these stocks up 10, 20% on the year with no news, even as U.S. tech stocks are cratering and all the bubble stocks, including the cryptocurrencies. All that stuff is going down. You got to get into real assets. You got to get into value. You got to get out of paper, and you got to get out of U.S. paper in particular, because we've got the biggest inflation problem that we can't do anything about because we're so loaded up with debt. There's no way to fight inflation without collapsing the entire economy, because the whole economy is built on the foundation of these artificially low interest rates. But in order to fight inflation, you have to remove that foundation. And then if you do that, everything built on top of it comes crashing down. But when you think, most people, when you think about a stock market, you're thinking about the entire market, an index. I'm looking at businesses. Like, let's say your company, the Rich Dad Company, if you went public and it was at a good valuation, at a good dividend, maybe I would want to own part of the Rich Dad Company. I could buy shares in your business. I want to own businesses. I have to get out of cash, but I can't own, the momentum stocks. I can't own these, high-flying companies that don't have any earnings. And I can't buy cryptocurrencies, which have no value or no earnings. They went up along with everything else. I want to own something real. So I own businesses, tangible companies that have property, plant, and equipment. And I also buy real money. I agree with you there. Buying gold, buying silver, buying mining stocks. That's where people are going to go to get out of
Peter, that's
harm's way when it comes to inflation.
Yeah, Peter, I'm going to support you right now because I think it's coming. I already see it. There's so much money floating right now. If there's hyperinflation, my generation, the boomer generation, they're toast if they're fixed income. Isn't that true?
The people who get hurt the most are the people who are retired. When you hear the news reports, they always want to focus on wages and whether wages are keeping pace with inflation, which they're clearly not. But at least if you've got wages and they're going up 5%, and prices are going up 10%, well, you're only 5% poorer. But if you're retired and you've got a fixed income and prices go up 10%, you get stuck with the whole 10%. And, a lot of these retirees have been forced out on the risk curve. They've got all these overpriced stocks that pay no dividends, and those stocks are crashing right now, and their whole retirement is going up in smoke.
That reminds me too, Robert, of that couple. So we have a precious metals dealer that we work with here in Phoenix. And he was telling the story of this couple. They were retired, and every 1 or 2 weeks they would come in and they would cash in one ounce of gold. So they had a storage of gold and they would cash it in whenever they needed it, and that was their retirement fund, and it paid off for them.
Well, people can do that now because and in fact, over time, you'll have to sell less and less gold. Maybe now you need an ounce of gold, and maybe in a couple of years, 1/10 of an ounce will buy as much as an ounce does today, because gold's going to go up dramatically relative to the cost of most goods and services. But the problem is, you put your money in the bank, you get no interest.
Correct.
And inflation destroys it. I mean, people want to say gold doesn't pay any interest. Well, 0 is better than -5 or -10, which is what you're getting on your cash.
So, Peter, that would be a strategy for an old guy, old person. They could say, well, maybe I should get out of cash. I mean, cash is still going to be good, but it's going to be declining with inflation. If there's inflation, I'm not saying there is or not.
What you want to do with inflation is recognize that the biggest losers are creditors, people who are owed money and are going to be paid that money in depreciated currency. So you don't want to be a creditor in U.S. dollars. So you don't want to own cash. You don't want to own bonds. You don't want to be in annuities, or you don't want cash value in an insurance policy. You've got to own real things. And that's why I'm buying all these foreign stocks, companies that pay very high dividends. I mean, I'm buying stocks some of them are trading for under 10 times earnings. Many of them pay dividend yields of 5 to 10%. I get that cash. I can spend it. If you're retired, you can use that cash to finance your living. And as the dollar goes down, the value of those dividends will go up. And of course, the companies that I own, they're all raising their prices now. So they're going to be able to raise their prices, so they're going to have higher earnings, and they can pay me higher dividends. So those increasing dividends will keep pace with an increasing cost of living. But a lot of Americans who are in the U.S. stock market, they're collecting no dividends. They just have overpriced stocks that are falling. And if they have money in bonds, the low interest rates that they're earning are completely inadequate. They're being more than offset by inflation. If you're getting 2 or 3% interest and inflation is 7 or 10%, you're going backwards every year, and eventually you won't be able to afford to maintain your lifestyle, especially if you're retired.
Correct. So Peter, one of the old standard, what I call financial planning thing is you go to stocks and then you shift to bonds.
Yeah.
And I am not really good at, I don't understand why would anybody put the money in a bond, because I never had any money anyway. I'd rather be the borrower than the bond holder, whatever it is. What's going to happen to bonds if they keep Q tightening? What happens to a bond?
Well, bond prices fall. Bond prices are falling. Take a look at what's happening. But the problem is not only are bond prices falling, but the currencies that they're denominated in are losing purchasing power. So you're just getting destroyed in bonds.
Peter, the reason I want you to say that is because there's so many guys my age, the boomers, they think they're safe in bonds.
No, bonds are riskier than stocks right now. I mean,
Yes.
It's unfortunate because bonds are where you're supposed to go when you want to play it safe, because you're not taking the risk of the stock market. You're guaranteed to get your money back, because the person who you loan the money to is committed to paying you back, and you know what your return's going to be because you have a fixed interest. But the problem is anyone who buys bonds now in this environment is overpaying. The prices are inflated because of the Fed. So you're paying this ridiculously high price for an asset that barely throws off a yield. And as interest rates eventually rise, the price of the bond collapses. But meanwhile, inflation is destroying the value of the bonds, of the cash rather, that the bonds are going to pay you.
Correct.
So bonds are extremely risky. I mean, people talk about treasuries as risk-free return. I've been calling it return-free risk for years.
The point I want you to make, Peter, is that so many people have in their mind bonds are safe. That's the danger.
They're not. They got to get that into their head. They're not safe.
So what if somebody owns a lot of bonds right now? What should they be looking at?
They should be calling me up to sell the bonds for them. They got to get rid of those bonds, and they got to get into something that is safe, at least relatively. I mean, nothing's safe anymore thanks to the central bankers. So you have to look at degrees of risk. And to me, I think it's a lot less risky to be in foreign equities than U.S. bonds. I think it's a lot less risky to be in gold and silver than in U.S. dollars.
That's why, ladies and gentlemen, the reason we wanted Peter on this show is please start thinking differently. Exactly as Apple said, think different. Because my generation is running in that old go to school, get a job, 401k, and retire. You invest in equities, which are stocks, and then you shift to bonds. That could be the most stupid, high risk thing you can do today.
The last decade was all about U.S. stock market. The U.S. stock market outperformed the rest of the world because the rest of the world's got value stocks and we've got hyped up momentum in tech stocks. And so the world wanted those stocks. They don't want them anymore. They're getting rid of those stocks. And that's also a big problem for the dollar because we were recycling our trade deficits because foreigners at one point took the dollars they earned selling us stuff and they bought our bonds. But then our bonds became so expensive, the yields were so low, they started buying our stocks. Well, now our stocks are really expensive. There's nothing that we have that they want. The dollar is going to collapse. But in the meantime, we're getting into these foreign stocks. We're building portfolios for clients, managed accounts. All of my mutual funds are loaded up on these foreign value stocks. They're the ones that are going to do really well in this decade. Nothing that worked in the last decade will work in this one. It's a totally different environment. This is stagflation. And the same thing with cryptocurrencies. If you bought Bitcoin, at the beginning of the last decade and rode it up for 10 years, you cleaned up, as well as a lot of these other cryptocurrencies. What's going to happen now is it's a rotation out of fool's gold into the real thing. So now it's time to take your profits in that Bitcoin that you bought a while ago and buy more gold and buy more silver, because this is the rotation. It's out of hype into value, and that includes out of cryptocurrencies into real money, into gold and silver. It's all about value, and it's about getting out of the dollar and protecting yourselves from a real economic crisis in the United States, because it's coming. We have delayed the day of reckoning for decades now. As a result, the problems are much bigger, so we have a lot more to reckon with. It is going to be a very, very difficult environment financially in the United States. Think about the 1970s, only way worse, much higher inflation, a much weaker economy, and we're starting from a much more vulnerable position. The political landscape is far scarier now. Socialism was not acceptable in the 1970s. Most people would not vote for socialism. Now people embrace socialism. Capitalism has never had a worse reputation, unfortunately, than it does right now. So it's a very dangerous time to be invested in America. And so you just need to do what you can. And that means they got to get out of U.S. assets now while they can, get out of dollars while they can. I think things are accelerating now. This is going to be a big year. It's not a year to sit on your hands and wait. You got to take action. You got to protect yourself because nobody else will do it for you.